Hi, this is Randy Finney with the right side of the chart, and today is Thursday, February 28th, 2019. This video will be a little bit different from most. We're going to do three different things. We'll start out here with a very quick update of the broad markets. The market's trading flat, literally as I speak. You can see an upper right-hand corner, 0.00% on the SPY. So not a whole lot to update, therefore won't spend a lot of time here. But there are a couple developments I do want to point out. Then we'll roll into a quick analysis, if you will, but more so than technical analysis, which I usually am doing in the videos here. It's more of an analysis of statistics. We're going to look at a few different periods of time, some headlines that have come out recently, and I continue to see a lot of buzz on some of the same statistics on how strong the first 2 months of this year were. And so there's also some stats on how bad January was. So we'll get into that real quick, and then we'll wrap it up with a brief look at some fundamentals, some charts on the economy. I had a member ask the other day, Randy, when are you going to do an update talking about where we are in the business cycle and in fundamental analysis? So we'll do that. It's all said and done. I'll try to keep the video at a manageable time. And again, those are the three parts we'll be covering. So if you want to skip ahead to any one, we're going to start out here with the charts. This is the S&P 500 or SPY daily chart, the S&P 500 tracking ETF. Same story, nothing much to report recently. We stalled right at that triple top, very significant resistance. Printed another red close yesterday, as I mentioned on the site, or maybe in the video. I can't recall. Sometimes I mention things on the website, sometimes in the video. We've only seen the market close. This is the third time since December, since we bottomed on December 24th. The third time in what now, going on the better part of 2 months, and that we've had two consecutive red candles. Now look, not a big deal really. If we have three, is that the end of the world? No, but it's worth pointing out. And again, it speaks to the momentum of the trend waning. The most powerful gains came here, and slowly we're rolling over. And no, the big question, I know we talked about it and we won't get into it real deep, is it just going to be a correction and then a move to new highs, or is it a slow roll and we go back down? We'll see. But watch today, because today will be interesting. Did they buy the market into the close today? It's about little before 1:30 as I'm starting this video. Or do they dump it into the close? That's another trend we've seen. I'll get to that in the 5-minute charts in a second. So if we do, we'll have the third consecutive day of losses in the S&P 500, which, hey, it's not a big trend, and maybe it's nothing. Again, it could be an aberration. We've had little pullbacks along the way, but it would definitely be the start of something new. So there goes that candle ticking red for me right now. So, but again, it's a daily chart. All that matters is how we close. All right. The only other things that I really want to point out on the daily charts, let's throw up that PPO histogram. Again, we're looking at a high level, very clean separation, pretty high probability sell signal, or at least confirmation of a bearish trend. I've talked about it quite a bit recently. Here's that big hill. I like to see these hills. And right now, again, the day isn't over. I talked about it yesterday. We had a cross in the QQQ, but it was early in the day, and Q's, I think the histogram closed flat at the zero line. So you can see 0.01. In other words, if we close at this price or lower, where we're at right now on SPY, which is flat, then we'll have that crossover, and that'll be the first bearish crossover since right here. One before that was right here, and then we had one back here, little whipsaw signal, and then got the real deal right here. So you do the math on whether those are pretty reliable indicators that the trend has changed or not. And so let's look at QQQ. And same thing, I told you yesterday we needed to see a close. We didn't get it. See that little red histogram bar? When I zoom in really tight, I'm virtually flat on the line. And as of now, it's red by just a hair. But again, it's more of the fact that it's that cross. And there are some people who use trading systems, some institutions, some algo trading programs that factor these things in, bullish and bearish crossovers on moving average pairs, on histograms or PPO lines, things like this. So that could bring in some more selling, and all I know is this is a potential powder keg right now of overbought conditions, over bullish sentiment, and et cetera. But again, I just wanted to point that out, that not only we have the recent trend line breaks, but we do have on the daily chart now, we have the indexes, most importantly the S&P 500, which is really the broad market, stalling out at major resistance. At the same time, you're seeing a high-level bearish PPO crossover. All right, let's zoom down here to the 60-minute chart of the futures, S&P 500 futures. Something I wanted to point out, and in fact, a member brought this up on the site. He posted a chart saying, Randy, he mentioned this wedge, and this is a wedge you recall back here. Um, off the lows, we were long and bullish at most of that, and then on the around the right there at that peak, that was when the first short trade I added since back in October to the site was right here on January 18th. That's when we peaked. And we had a correction, but we had a correction in time more so than in price. It was a decent, it was about, I think, a 2% or a little under 2% pullback on the S&P and almost about a 3, if I recall, on the QQQ. But I've said it back then, and I've said it dozens, if not hundreds of times over the years that stocks can correct in one of two ways, either in time or price or a combination thereof. And so what this was is more so a combination, or more so a correction in time, if you will. And then we broke above that consolidation period there, back tested it from above, back tested and moved up. And so where I'm going with this is the question from that member was, are we looking at this again? Because now we've had a breakdown of this larger wedge, and all we're doing right now is moving sideways. Is it possible? Well, my answer was yes. Most certainly it's possible. Anything is possible. Is it probable? No, not in my opinion. Why? Because the technicals, everything that I've been covering for weeks now, a lot more bearish evidence than there was back here at this point in time. The markets, when you go back out to the daily charts, are they're overbought, more overbought than they were at that time. Bullish sentiment is a whole lot higher than back then. Bearish sentiment is a whole lot lower. Short interest, everything else. The high-level bearish PPO crossover. So in other words, back here was a decent case made for a short. Well, kept our stops small, didn't work out, no big deal. I think there's just a stronger case to be made now. Still doesn't guarantee it'll play out, but and I'm talking a case for a decent correction in price, more so in time. All right. Okay, and as we move on down the time frames here, we started with a daily. We're just looking at a 60-minute chart. This is a 10-minute chart, and here's something I've pointed out recently. Now, again, I don't want to try to extract too much from this, but it's worth pointing out. I see a lot of dejected, people who are short, traders that are short, and every time the market has these little kickback rallies, there's some chatter. Oh gosh, it's never going to go down. They're buying the dips. Shorts aren't working anymore. Keep in mind, ignore the intraday rips and dips. The bigger picture, or at least let me back up. The very near-term trend, and again, it's not an established trend, but this is the shortest-term trend, is clearly bearish since the highs on Monday. The market gapped up on Monday and has clearly been moving lower since. So that's the reality of right now. Does that make a long-term trend? Does it make a trend that you can go 100% short on an aggressive account or pull all your money out of if you are long and trying to ride this trend up? No, but it is a start of something. It's something worth monitoring. So each and every day so far, we've had a downtrend. Market has closed. Again, it closed green on Monday, but it faded a lot of those gains. And this is the other thing I wanted to mention. There has been a trend of institutional buying, which is late day buying up into the close. That is from ETFs. ETFs and mutual funds have to square away their positions at the end of the day due to redemptions or inflows. Get a lot of inflows, they have to buy futures, load up, and that's why you see those late day ramps and moves up. So this was a clear uptrend, not very powerful when you back out to the daily, but a pretty clear uptrend. And again, this is a point I'm trying to make. And so let's take it day by day. Right now, just red. Again, this will be the third red close in a row. And if you count the highs on Monday, then, we faded that. Still closed slightly green. We just barely missed a red close. There was the gap from Friday. And so this is what I'm watching. And it is the early makings of a possible trend, but it also could be another pullback. But again, we're taken in context with all of the other evidence so far, and what I've said in the trading room is most importantly, forget about these intraday rips in the noise. Watch what happens in the close. Let's see if we see another trend of selling into the close, which is indicative of institutional selling, indicative of outflows from funds. And basically, this is a momentum market, and it has been for many months now. The momentum was clearly to the downside last quarter, although we had some rips and dips in between. and the momentum has been to the upside, but nothing lasts forever. So that's what a big part of my trading style. More than a trend trader, I like to catch inflection points, tops and bottoms, and that's where the biggest moves are made, and that's why right now, even if this market does trade sideways for a while, even if it pops above those highs, the resistance I showed you on the daily, I still maintain, at least in my opinion, the risk reward to going long here or staying long is just not favorable. That's my take. So we'll see what happens. Okay, this one's been bothering me a little bit recently, only because I've seen it out there, in the blogosphere, internetosphere, whatever you want to call it, social media, in the headlines. This one I pulled off a Wall Street Journal article, and but yeah, you guys have probably seen this. I talk about there's just a lot of buzz about how strong the rally has been and how strong the first 2 months of the year have been. And so here's a chart that puts it in perspective. And as you can see, it talks about the S&P performance in years, which the index rose at least 10% in the first 2 months. And so here's how I look at this. What jumps out to me immediately, and again, I'm seeing this on almost every instance, it's spun very bullish. And maybe I have a thick pair of bear goggles right now that I'm seeing through, but I'm going to show you how I interpret this chart. What stands out to me, I'm a historian of financial markets. I've been former stockbroker. Before that, I was a business major. It's just, fascinated with the financial markets. I love trading, investing, all of it. So what jumps out to me, I think any buddy who's been around for a while and studied the financial markets, there's 2 years that stand out above all and any, and that would be 1931 and 1987. 1987, of course, was Black Monday, the biggest drop ever in history, 20+% drop in one day, and that was part of a larger correction. In 1931, we all know that's right when the Great Recession, one of the worst bear markets, or the worst bear market ever, got going underway. So what stands out to me is some of the biggest January, February gains came right before those market crashes. So you can look at this one of two ways. And again, this is, just food for thought. We don't know what's going to happen yet. So let's take 2019 out of the equation because that's a big question mark. That's everybody's guess, but that's what we're trying to get at here. So then you look at 6 periods, and of those 6 periods, 4 of those, three, 4. 4 of those were up. So we have 2/3 of the time. If you just blindly put your money in, let's say you missed this rally, or you're long now, it doesn't matter. But at the end of February, you say, wow, we just had record 2 months. It's only happened a few times in history, 6 times in history before. For those 6 times, 2/3 of the time, the market went up by the end of the year, even though the gains weren't as strong. The odds are in my favor, so I'm going to just go ahead right now and put all my 401k money into the stock market. Well, I used an analogy the other day on something else about horse racing. You go to the track. If you bet the favored horse, I've only been once. I went to the Kentucky Derby once a few years ago, and so I'm not a big bettor, but I remember watching the odds change and all that. And when you have a favored horse, sometimes, if I'm not mistaken, the odds come down to about 1-to-1. Meaning you bet $100, guess what you're going to get back? You're either going to get 100 if you win the bet, or you're going to lose all your money. To me, that's a sucker's bet. I wouldn't take it. It's just, I don't know. It's pure gamble, especially with whatever there are, 6 horses, whatever in the race. Now, you watch the long shot, however, the odds can really get up there. Bet $100, you can win thousands of dollars if that long shot hits. And so what I look at are in probabilities. I say, okay, so you have a 2/3 chance of making money. But the gains are relatively muted. You're talking, they don't give me the numbers here, but I can just eyeball that and tell you if this is 25% and there's 0, 12 is here, 10, so that's probably low, mid to maybe even high single digits at best, but single digit average. Whereas you have a 1/3 chance of losing money, but not only losing big. So here's that long shot, but yet the odds aren't that bad. Again, it's really, what is that, 2-to-1 odds or 2-to-3 odds, how they call that, because these big gains came right before a market crash. Nothing short. These were some of the worst market crashes, or the worst market crashes in history. So Take it for what it's worth. And again, this is statistics probability. Now, here's the good news. When you go to the track, you buy a ticket, you bet on a horse, that's it. You can't walk back to the window 5 minutes later, say, hey, before the race starts, say, look, I changed my mind. Can I take this? I want to bet on this other horse. I want to cash. No, no. The good thing about investing is you can use stops. You don't have to be married to a trade, but this does help at least maybe paint a picture that, hey, as good as January was with these stats and as rare as that was, there's a little, a thorn in the side there. And so either things are going to be pretty good this year, we're going to have an up year, or we're going to have a really bad year if you want to take it from. And again, if you're familiar with statistics, this isn't a big sampling, big amount of sampling data. You only have 6 data points, but it is worth noting. Again, that's what jumped out to me. All right, let's move off that one. Oh no, sorry, we don't move off this. There's something that I think is very important to discuss, and this is something that I really make an effort to do anytime. Because all the time I'll hear things about seasonality, whether it's the January effect, the Santa rally, sell in May, go away, all those things from the Trader's Almanac that go back forever. I do not take them on blind faith. I think a lot of traders do. They just look at seasonality and say, okay, I have a blank percent chance of the market going up or down over the next few months based on seasonality. Well, I do look at that, but then much more importantly, I factor in where are we in the market cycle, okay? Because if you have, some Januaries, for the most part, you get the January effect, which is bullish for small cap stocks, but some Januaries you can get decimated. So it's very important to look at where you are in the market cycle. So that's what we're going to do here real quick. We're going to take these 6 periods, and remember, that's just the first 2 months in these years, and look at where the market was. And that will give us some more clues and maybe give us an additional filter. And this is how my mind works, to see, which of these years that you did have additional gains, what was happening at the market at the time. So let's take a look and I'll show you what we mean. So we'll work our way up from 1931. Okay, here's 1931. We already know it was the top was already in. And so what I did on each of these, I just put a line. This chart would allow me to put a line right at the end. That's the closing value in December. So anything from this point, from that dot, shows you, and again, this is a 1 year span right here. So that's about the 2 months there. So this was purely a bear market rally. Now this one I don't really have to do, we all know what happened because you could see the abysmal return on that previous graph I just showed you. So again, by going into that signal saying, wow, stocks are off to a great year, it's going to be a great year, you got clobbered. In fact, you win right at the top. That couldn't have been a more misleading, if you will, buy signal. And again, they didn't have these stats back then. I'm just pointing out that one obviously, and again, take it in context where it came. It came shortly after, relatively early on in a new bear market that followed one of the strongest bull markets in history. Okay, next up would be 1943. So again, this shows us the value here, where the market was at the end of December of 1942. So there's our strong start to the year. And guess what? And again, this is where I take it in context. That was a good signal. You had a correction afterwards, but see, what happened is that move came at the end of a vicious bear market. This was a multi-year bear market. And so we're just coming off the lows. We're in the early stages of a new bull market that went up for years. So consider this, if you will, rewind, and let's just say that signal came back in 2010, this time around in this bull market. So if a signal comes early in a bull market, I think it's much likely to be a good buy signal if you have those strong January, February effects. But again, if they come late in the cycle or early in a bear market, not so much. So this one, we'll give it a check. That was, whatever the stats were back then. They were on that first chart, but that checks out. Next up, this is 1975. So there we are at the end of December 74. There was our strong rally into early in the year. You had a correction. And again, that was probably about the top. Some of these, I'm not on the live chart. You have to move a crosshair into data point. But that will show you that was roughly highs. Then you had a pretty decent correction. Then you pushed up. but we were still, that was a bear market rally. That's all that was. That was a bear market rally. Why? Because this was the top of a bull market. This was the bottom of that, or let's say the start of the bear market, the bottom of the bear market. And so that super strong January, February was simply a bear market rally, which, as I've said many times, can be explosive, and you may have just witnessed one. And next up is 1976. They had another data point. I guess that was a, pretty vicious bear market then back then in the, heading into the early 70s and beyond. And so you can see the moves. By the way, the shaded lines are just recession. So again, here was our strong start to the year, and shortly after that, the market peaked and continued on down and fell quite a bit. So again, not a rally you would have wanted to chase up to that point. If you weren't already in it. In fact, you would have put your money in right around the end of that bear market rally there. Okay, getting up closer to modern times. Here's 1987. Again, the year with the worst market crash in history, Black Monday, and of course it wasn't just a one day. There was, market started to roll before that. A lot of similarities actually leading up to this top. Point being, so that strong, super strong January, February rally in early '87 came at the later stages of a bull market that was off the lows here in around 1982 or so. So that's a late stage bull market rally, and what's the signature of that? It was followed by a market crash. So I guess the point where I'm trying to go with these is, if they come early on in bull markets or somewhere else, you probably have a better chance of that signal playing out, and a much lower chance, obviously, of a market crash or a big swoon down afterwards, or a resumption of a bear market again if you're already in one. And last but not least, this was the last time we had, other than the January February rally we just had, and that the performance afterwards is yet to be determined. We won't know that till the end of the year, but 1991. So at the end of 1990, that's where we were. This was the start of the longest and most powerful bull market in history. The one we're in now will soon overtake that one, but that was early stage bull market action, and certainly a good time to go long even after that January, February rally. Where we're at now, let's just look at one other chart. So this is where we're at now. We are at, again, it's open to debate whether it's the tail end of one of the longest, it's one of the longest bull markets in history, soon to be the longest. But are we at the tail end, or does it have a lot more room to go? Because, like I often say, records are meant to be broken. This was the end of the 2000 bull market, followed by a bear, 2007 bull market, followed by a bear, and this one yet to be seen. We certainly know it's long in the tooth, and now we'll conclude this video with just a few charts and get to look at fundamentals, because fundamentals will help tell us too. Fundamental analysis, you don't see me cover it often because in swing trading it's useless, absolutely useless to time a trade that's going to last a few weeks to maybe a few days, a couple months at most. It's very useful for investing in trend trading, getting in a trade that you might hold for 6 months or more, or even years. So the best trades and longer term trades come when you can align a bullish or bearish technical case along with a bullish or bearish fundamental case. That makes the best trades. So let's take a look at a few things and we'll wrap it up. Okay, starting out here, we'll look at a simple chart of the business cycle. There's a few certainties in this world. Death, taxes, those are a certainty, and the business cycle. Now, the business cycle, it's like the seasons. It's guaranteed to happen. Where there's a summer, it'll be followed by a winter eventually. Now, the only difference is it's not as predictable. It's not in such a set pattern, but this is a very simplistic view. You have an expansion phase in the economy, a peak, a recession, a trough, and the cycle repeats. We can look at a few other charts that tell you the same thing in a little more detail. Here's another chart of the business cycle with a little more detail. And again, so the trend is, and people make this point, it is a point to note that over time, the economy and the market's going to go up. And, if you invest long enough, you'll make money in the stock market if your time horizon's long enough. But keep in mind that contractions, particularly bear markets and recessions and expansions, by the way, do not always overlap. The market usually turns down first. The other thing to note, I'm going to say it now, recessions are declared in hindsight. They come out after the fact. They make after the fact revisions to GDP, because that's what's the one metric really used for the recessions. It's considered two or more contracting quarters of GDP, or negative GDP, I should say, and that's going to come out in hindsight. So I promise you this: by the time that the government tells you we're in a recession or it's declared officially, your stocks are going to be down. Your portfolio, if you're long, your 401k will be down 20% or more, because the market will price it in first, well in advance of the before it's actually announced. And of course, part of that too is the timing. GDP was released today. They only release it every quarter. When they release it, it's already a month old, the data anyways. And then again, after that, it's subject to revision and after the fact. And so after the economy slows, you'll see the downward revisions come in later. Okay, so with that being said, you can see this is how it works: expansion, contract. So where are we? A lot of I'm not an economist, but I can tell you a lot of the more reputable ones out there. I think the consensus seems to be, what I can gather, we are unarguably in the very best late stage expansion. You have early stage, you can really get, break down different areas in here. So that's where we are. And, can it continue for a while? You don't use fundamentals, like I said, as timing indicators, but we're going to take a look at a few right now and let you be the judge of where we might be in the cycle. And here's, before we do, here's one other chart. Another chart of the business cycle, again, showing you the peaks and troughs in the economy, contraction, see down here, expansion, prosperity. And we're certainly right here now. You're reading all the articles, how the rich are getting richer off this, the stock market boom, the disparity in wealth and income created by the financial bubble and the QE that came afterwards, that inflated stock prices more than it inflated the actual economy. But again, let's go take a look at some of those indicators and we'll wrap it up. Okay, here's one we all hear a lot about. I don't care if you follow the markets closely or not. You're going to hear about unemployment in the economy. So this is the national unemployment rate, and I'm sorry, I start on retail sales. We'll start here. That's fine. No, it is employment. You know what I did, guys? I'm sorry. I cut and pasted. These charts didn't have the titles right above it. This is employment rate. I could tell by looking at it. So we'll get to that in a second. Okay, so yeah, I was going to fix that now. It doesn't matter. Okay, so this is the unemployment rate. And you can see, again, it's glass half full, half empty, or half full. If you're wearing bear goggles, then what you'll note is that there's a famous saying in Wall Street that it's always darkest just before dawn. Think back to 2009. Remember what you were thinking if you were investing in the market back then, had your 401k, didn't know what you're doing. You probably thought the world was about to come to an end, and as we headed into March of 2009. That was right before the bottom. So that's where that saying comes from. Well, I use a corollary. I haven't seen it out there, but I say it's always brightest just before dusk. Don't worry if that makes sense, but I think you get what I'm saying. In other words, the economy and markets peak when everything is as good as it possibly could be. That's when things peak. And then, of course, stocks usually start reflecting it before. You'll see it on the economic numbers. But what you can't argue, go back in time, and it looks going back all the way to the 50s, and you can see that unemployment peaks. By the way, the gray shaded lines are recessions. So unemployment peaks just before recessions. And you can see, for the most part, these are the extremes. That's as far back as the data will go. But you can see these extremes here, at least since the 50s. Now, you're going back, almost to, World War II there. So modern times, let's just say, we'll start counting late 50s, 60s. Really, the unemployment rate doesn't get much lower than this. And when it gets that low, that's a sign that tells you, guess what? And there's a lot of forces, positive, negative feedback loops in the system that when things are booming that good, because if unemployment's super low, all of a sudden jobs are becoming harder to fill, wages start going up. The employers find a hard time finding qualified work. They have to pay their employees better. Profits start suffering. That's why there's that feedback mechanism in the economy. So right now, take it for what it's worth. You can see where unemployment has fallen to. It's fallen to levels in the past that have preceded recessions. And, of course, bear markets, which are not shown on this chart. Okay, so we were looking at the national unemployment rate a minute ago. Here's another one that I like to track, U6 unemployment rate. And as it says here, that U3 is the official unemployment rate. Then they have another one called U5, which includes discouraged workers and other marginally attached workers. And then the U6, which we're looking at here, adds on those workers who are part-time purely for economic reasons. And as you can see here, this one only goes back to the 90s. But what you see are pretty just clear trends down. Unemployment's falling, unemployment's falling. All of a sudden, it starts to turn up. You'll notice a turn up. I wish I had I can do it here. Let me grab another pen tool, drawing tool. Well, what I was trying to do is show you, you could see the turn up there. I was trying to draw a curve. But you can see things turn up, and you can see them turn up, of course, before the recession, or at least this is when the recession was declared. Again, you can see the turn up right there. So you can almost draw downtrend lines on each of these and see you had falling unemployment, and then that's when it gets down to a certain level, which is right about where we're at now. You can see each of those lines. That's it. And you can see this turn up now. Again, you can draw a trend. You can see that trend. Not a perfect trend line, but it's pretty decent. You can see that trend's been broken. And also you can see this curl up here that we're seeing already recently. This is more, you had little zigs and zags along the way, but nothing like this. This to me looks like a clear so far, and we'll only know in hindsight. It could be a blip, an aberration with another trend down, but it looks to me, or at least you can't argue, that unemployment is now turning up. The unemployment rate is going higher instead of lower. We're also very stretched. Look at the distance between the previous recessions and right now. So again, another one to pay attention to. This is auto and light truck sales. You can see going back to the 80s recessions, pretty much back there. The way I look at this chart is I see back in the 70s and the 80s, barring these aberrations, at least when you have spikes like that, it's just an aberration. You can kind of see that the extremes around that 16 level, 16 million units, that's about where things topped up to that point in time. But again, over time, certain indicators change. The values go higher or lower. VIX is a good example. In recent years, it fell to levels it never had, so it established a new floor, if you will, up until the market top, the first correction in 2018. And so it seems here that the recent top, well, clearly, again, exclude these aberrations up top. You can see around 18 million units. That's where we peaked out last time. Now, look. You can see we peaked out back in the late 90s, and we kept in that topping range for a long time before we fell down below it. And that may be the case going forward. So like I said, we can't say definitively, not even close. And of course, the numbers tell us we're not yet in a recession, but they're very indicative of being at or near, very near a top. So to me, and I think most people, it's just a matter of, okay, do we have another year or maybe even two left in the bull run and the expansion of the economy, or has it likely ended? Because there are a lot of indicators lately that have been turning down and rolling over. And last but not least, I promised you retail sales. That first chart that was labeled as such was actually unemployment. As I said, this is retail sales. This one goes back quite a ways to early 90s or so. And what stands out when I look at it, I see pretty clear trend lines. You can see I drew those trend lines. Now in this one, we had really a sharp spike trend there, a little smaller uptrend that was broken. And that was a mild recession, you can see. But of course, we had the big dot-com bubble. Remember, the bear market back then in 2001, early 2000, 2003, was more so, or a big part of it, just the blowing up of the tech bubble, the internet bubble, anything with dot-com. But again, you can see a pretty clear trend line, and then retail sales resumed. Another nice trend line. They broke trend, and traded sideways for a while. But of course, like everything, they peaked before the recession, then they fell off a cliff during the last recession. And now we have, again, a pretty clear trend line. And if you look, you can just see us cracking below. Not with conviction or anything like that, but we are starting to crack below. And just one to watch. Again, it's not really flashing anything right now, glaringly red, but if you continue to see it move down, that trend gets broken. It's one of the things I like to keep an eye on. Okay, guys, that's it. I hope you enjoyed it, and I know this whole video is, talking about, potential bearish things. And I do that because, look, a lot of it's out there, the bullish stuff, the vast majority. I get the paper, I'll read online, a lot of financial publications. I'll, get the buzz of what's going on in the trading room on the site. The vast majority of market participants are bullish now, just as they were bullish leading up to the top in October. And, hey, maybe there is more life left in this bull. Maybe 2018 is going to close, or at some point in the year, we're going to take out the highs that we put in last year. But either way, I just wanted to point out these things. These are some of the things that I watch. And again, this was by request from a member on the site. So these are some of the fundamental economic indicators I look at, and I'll continue to monitor these as we go forward. All right, this has been Randy Finney with Right Side of the Chart, and I hope you enjoyed it.